You walk into a store, tap your card, hear the little beep, and in that split second, your dollar vanishes. Not just leaves your account, vanishes into a global machine that immediately starts pulling it apart, multiplying it, selling it, lending it, tracking it, and, ironically, using it against you. And here's the strange part. The moment you spend that dollar, it stops being yours and becomes something much bigger, something you never see, but that quietly shapes your rent, your salary, your future, and even the next financial crisis. Most people think, I spend $1, end of story. But that's actually the beginning. Right now, every major economy is running on a knife's edge: high debt, rising prices, constant market shocks. And the average person keeps hearing inflation, interest rates, liquidity, monetary tightening. But none of that makes sense until you understand the life cycle of a single dollar. Because once you see what your money actually does the second it leaves your hand, you see the entire system differently. You see why things feel more expensive, why saving feels harder, why debt grows faster than paychecks, and why the economy runs on confidence more than cash. So let's follow your dollar, step by step, from the moment you spend it to the moment it becomes part of something you never agreed to. Step 1. The transaction. You tap your card. Let's say you buy a coffee for a clean round $5. $5 leave your checking account, or at least it looks like they do. In reality, your bank isn't moving physical money, it's updating a digital promise. Your bank tells the merchant's bank, hey, we owe you 5. The merchant's bank replies, cool, we'll add 5 to their account. This entire exchange, by the way, is happening inside a private network run by Visa, MasterCard, or another payment processor. Your dollar is a data packet, less paper cash and more IOU inside a corporate database. This alone is strange. You didn't send money, you sent a message, and everyone involved simply trusts that message. But this is only the first stop. Step 2. The merchant's bank doesn't keep your dollar. Let's follow that $5 after it lands in the merchant's account. Do they store it? No. Banks don't store your money like a vault in an old movie. They recycle it instantly. Because every dollar that enters a bank becomes fuel for loans. Banks keep only a tiny fraction of deposits on hand. The rest isn't sitting, it's moving. Your dollar becomes part of a giant lending engine, your bank's real business. Meaning, you buy a coffee and your money might be used a few hours later to help fund a mortgage, a business loan, or a credit card balance for someone you'll never meet. Your $5 purchase didn't end a transaction, it started a chain reaction. Step 3. The multiplication. Here's where things get weird. Your dollar doesn't just get loaned out, it gets multiplied. If a bank receives your $5, it might legally lend out $45 based on it. Not because it magically has $45, but because the banking system allows banks to create new money through lending. So the moment your dollar hits the merchant's account, the banking system quietly turns $1 into 9, 10, sometimes more. Your single cup of coffee helps expand the money supply, which ironically contributes to prices slowly rising over time. Yes, your dollar is helping create the inflation you complain about, not by itself, but as part of a massive invisible chain. Step 4. The financial markets grab a slice. But that's not all. Large banks don't just sit on deposits. They move them into short-term instruments, treasury bills, overnight lending markets, money market pools. Your $5 might live inside a government bond for 12 hours. It might be lent to another bank for a single night. It might be pooled with millions of tiny transactions into something Wall Street traders treat like a giant bucket of liquidity. For a moment, your dollar becomes part of the bloodstream that keeps financial markets from collapsing. It supports trading, liquidity, interest rates, things that feel far away but determine the mortgage you can afford, the return on your savings, even the stability of your job. You thought you merely paid coffee, but your dollar is now on a brief tour through the global money maze. Step 6. The government gets involved. Every time dollars move, taxes enter the picture. Corporate tax, income tax, sales tax, payroll tax. Your $5 becomes part of revenue calculations, part of national statistics, part of government decisions about spending, deficits, and borrowing. The government uses these flows to predict how healthy or unhealthy the economy is. So your purchase becomes a tiny data point in a giant dashboard that central banks stare at while deciding whether to raise or cut interest rates. Your dollar contributes to the mood of the entire nation's policymakers. Not directly, but it's there, buried inside the averages and charts. Step 7. The hidden mechanism. Now comes the uncomfortable part. Your dollar doesn't simply disappear from your account and reappear somewhere else. It becomes debt. Everywhere. For the merchant, it reduces debt. For the bank, it fuels debt. For the government, it measures debt. For the financial markets, it prices debt. Debt is the real currency of modern economies. Your dollar is just the ticket that lets debt move around efficiently. Here's the irony. Most of the money in the world doesn't exist as cash. It exists as obligations, numbers on ledgers, promises between institutions, expectations of future payment. When you spend $1, you're not moving money, you're activating a network of agreements that depend on trust, speed, and constant motion. If everyone stopped spending for even a few days, the system would choke. Not because businesses fail that fast, but because the flow is what matters, much more than the dollars themselves. 7th step, hype versus reality. People often imagine money as something solid. $1 is $1, simple. But in reality, your dollar is a message, a placeholder, a claim, a statistic, a tiny gear in a gigantic machine that never stops moving. Some influencers talk about your money working for you. Cute idea, but most of the time your money is working for someone else. Banks use it, markets leverage it, governments track it, algorithms analyze it. Your dollar is valuable not because of what it buys, but because of what other players allow to do behind the scenes. Zooming out, the implications. Let's step back. Every dollar you spend does at least 5 things at once. It completes a transaction, it fuels the banking system, it expands the money supply, it supports financial markets, and it influences government decisions. And all of this happens in seconds, automatically, without anyone asking your permission. Which raises a bigger question. If your money instantly becomes part of a system you don't control, then who does control it? Is it the banks? The government? The markets? Or is no one actually in control and the whole thing survives only because millions of people keep topping their cards and trusting that the promises behind the numbers still mean something? That's the uncomfortable truth. The modern economy isn't built on dollars, it's built on belief. Belief that messages sent between banks represent real value. Belief that loans will be repaid. Belief that markets won't freeze. Belief that the system will keep moving tomorrow the same way it did today. Your dollar works because everyone agrees to act as if it does. So, the next time you tap your card and that little beep rings out, remember, you didn't just buy a coffee. You nudged a global machine. You fed a system of promises. You became part of something much larger, far more fragile, and incredibly dependent on movement. And that leaves us with one final question. A question the economy quietly asks every time you spend a single dollar. What happens if the flow ever stops?